Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to another season of Talking with Traders with me, Garth McKenzie. This is the 6th season of the podcast, and we're into our 3rd year since the podcast began in 2020. Once again, IG have come on board as sponsor and agreed to fund this podcast for another season. We really are privileged to have such a global leader in CFDs trading as our podcast sponsor. Over the coming weeks, I'll be interviewing various guests from around the globe to bring you their market insights. I'll be digging in to find out what makes them tick, how they see the markets in the year ahead, and what techniques they will use to succeed in the markets. Some of the guests will be returning guests from previous seasons, and some will be new guests that I've managed to convince to join me to give up their time and share their insights. As we enter 2023, there's as much uncertainty as ever around where the markets may be headed in the next 12 months. We've just come off a horrid year for investors in 2022, where a typical 60-40 portfolio delivered its worst annual return in several decades. But what of 2023? Will the US lead the world into a global recession, or will the central banks manage to achieve a soft landing for the global economy? Will inflation come under control as base effects kick in and supply bottlenecks open up? Will US earnings hold up in the face of a weak economy, or will they disappoint? Will we see continued weakness in the US dollar? I'll be asking these and many other questions to my guests in the coming weeks. The idea behind these podcasts is for you to get a variety of views from a broad spectrum of market professionals. None of this is intended to be seen as financial advice, but it is intended to get you thinking and to weigh up what possible paths the market may follow in the year ahead. Please remember to subscribe to this podcast in your favorite podcast app. That way you'll be notified of upcoming episodes as they get released. Once again, thanks to IG for sponsoring this podcast for a 3rd consecutive year. Thanks for joining me, and please enjoy Season 6 of Talking with Traders. Welcome back to another episode of Talking with Traders, and this time I've got another new guest on the line. I'm delighted to have someone from Anchor Capital join us. This is the first guest we've had from Anchor Capital. His name is Seleho Tsatsi, and he's an analyst at Anchor Capital. He's going to mainly be speaking to us about green investing today. Seleho, welcome to the Talking with Traders podcast.
Thanks, Garth. Great to be here.
Yeah, good to have you. Give us a little bit of background quickly. I always do this with new guests, just as to who you are, your career history. I mean, I know you're pretty young still, but give us a little bit of background quickly into who is Seleho Tsatsi and what you're going to talk to us about today.
Thanks. Yeah, it doesn't feel like I'm that young anymore, but I'll definitely take it. So I've been at Anchor for, this is now my 8th year.
Wow.
So since near the end of 2015. And through that time, I've been covering resources locally. I've covered a few other sectors also on the JSE, but I've primarily focused on resources. And then because we also focus on offshore markets, in offshore markets, I'm more of a generalist. So I'm looking at stocks across different sectors. It could be energy, mining, industrials, tech, really anything. Okay. And before Anchor, I was at another asset management company for about a year and a half or so. And then before that, I was studying.
Okay. All right. Super. Good. So what got me onto wanting to speak to you was one of the recent Anchor Market Outlook webinars, which I know you guys do. I don't know if you do it quarterly or half yearly, but I tuned into the one for now the 2023 Outlook. And you had a very interesting presentation, which went alongside a blog article that you've recently written about green investing and where the opportunities lie, and just trying to unpack the theme a little bit. And I know, I mean, this podcast is talking with traders, isn't it? You're not a trader, you're an analyst, and this topic so some listeners might think, what does this have to do with trading? The reality is that the green economy, the shift towards a more green economy, has very, very significant investment implications. What I want to start the conversation with is some stats around carbon emissions and greenhouse gases and these kind of things. You had some very interesting stats on your blog that you put out there. So just lay the background, if you would, in terms of that, so that it's sort of tees us up for the rest of the conversation about why green investing is a theme, and it's likely to remain a theme for time to come.
Sure, Garth. Yeah. So maybe to set the stage, at the moment, as a globe, we're emitting about 50 billion tons of CO2, of carbon dioxide equivalents, on an annual basis. And the long story short, the effect of that is it's leading to an increase in the average global temperature. So I think at the moment we're at about 1.2 degrees Celsius higher than pre-industrial times. And it doesn't sound like much, 1.2 degrees. You're like, okay, what's 1 degree? But these small shifts in average temperature have huge ramifications for our economy and our health and kind of how we can live. If we look at COVID, I think 2020, where we, as a world, we kind of stopped and all just paused how we lived. Even in 2020, global emissions only fell by about 5%, which is, I was stunned when I heard that. So I think what that tells us is that if we want to get to net zero, and so net zero is this idea that we need to stop emitting, really get that 50 billion tons down to zero. Yeah. If we're going to get there, we're going to have to really change the way we it's not a question of doing less of what we're currently doing. We're going to have to fundamentally change how we are structured in terms of our economy and how we live our lives.
Okay. Well, I was also stunned by that figure that you said, that we only lowered global emissions by 5% during COVID. And you think just what we all had to go through in terms of no travel, work from home, supply chains that got frozen up, et cetera, and you think all of that, which is an enormous behavioral change for everybody, yeah, all of that, and we only managed to reduce emissions by 5%. I mean, it looks like mere behavioral changes are not going to do it for us, right?
Yes, exactly. So there's a nice analogy that Bill Gates had in a book he wrote on climate change, and he was basically saying we can think of the climate as kind of being like a bathtub. And the idea is that we can think of emissions as kind of filling up the tub. And eventually, if we keep filling up the tub, we're going to get to a point where it'll overflow. And we can think of that overflow as being the kind of economic and health consequences that we don't want to have. So this idea of net zero is that first, we need to stop filling up the tub. So that's net zero. We stay where we are. But then hopefully at some point in the future, we can actually reduce the amount of carbon in the atmosphere, or CO2 equivalents in the atmosphere. That could be through some technologies that at the moment are very speculative. So things like direct carbon capture. At the moment, it's a bit of a speculative technology, but that's the idea, is that we basically need to get to net zero, at least as a first port of call.
Yeah, I mean that net zero, right? I get it. We want to get there. We need. What does it mean, though? I mean, does it mean that we can still be emitting pollution into the environment, but if we plant more trees, for example, those are putting out more of the good stuff. I'm really making a hash of this, but I mean, I think you get the point. Net zero, right? It's you've got all of these emissions on one hand, but then you're also trying to balance it out so that it's not like we're not putting out any pollution into the world, right?
Exactly. I think you're hitting the nail on the head. It's not the idea is not that we're going to get our let's say gross emissions down to zero. It's more that we're going to get our net. So we're going to at least offset what we're emitting.
Yeah. Okay. Yeah. I see a big conundrum at play here. The growth and global growth and economic growth, which is such a big thing, and for society in general, economic growth is very important. But what's driven growth in all of the decades past has been energy and manufacturing mainly, and those are inherently dirty things. So we've got this situation where we still want to try and achieve economic growth, but these aspirations are completely anti-growth, it would seem. I don't know what is your thoughts on that?
Yes, it's such an maybe irony isn't the right term, but it's an unfortunate consequence of growth is that there's a very strong correlation or relationship between let's say income per person or GDP per capita, and you see that across nations and energy use per person or energy use per capita. So, naturally, as we become wealthier as individuals and economies and societies, we want to use more energy. And I think where this gets a bit political is that the developed world is essentially more responsible or mostly responsible for the amount of emissions that have been that we have given the size of the economies. And you now have the developing world, which wants to, bring people out of poverty, and that's great, and we should be aspiring for that. But that is going to come with the unintended consequences of higher emissions and these ramifications that we kind of touched on.
And I guess also, and you mentioned the term political. There's all of the countries involved, and need to kind of pull in the same direction. You've mentioned the Paris Agreement in your blog article, which essentially is an agreement amongst 190 countries, I think, yes, to get towards net zero. And I think what was a big shock for a lot of people was when Donald Trump was in power in the US and he pulled out of the Paris Agreement for that time, and that the US obviously is one of the biggest emitters of carbon into the atmosphere, right?
Yes, yeah, it's.
We've got I guess another conundrum in that look at China, for example. I mean, they're also enormous emitters, but that's also pulling people out of poverty. And it's tough, right, to try and think that they've got to try and get. It would imply them also slowing their economy down, surely, to try and achieve this net zero, which I just don't see how that's going to happen. I mean, are we? Is this net zero thing a reality? Is it realistic to think that we ever get there?
So I think if you look at China, I mean, that's a great example. They've pulled tens of millions of people out of poverty through economic growth. And alongside that, their emissions have skyrocketed. On an absolute basis, they are the biggest emitter. But if you look per person or per capita, I think they still trail the US. But I think it's unfair to expect developing economies to forego economic growth and to say, okay, it's unfortunate that you guys are still developing, but keep your emissions low. It doesn't seem either realistic or likely that developing economies will go for that. So I think what's more likely is that developed economies, the likes of the US, Europe, will lead the way, and then developing economies will follow after. Even under that scenario, I think it's going to be tough. As you said, President Trump pulled out of the Paris Agreement. I mean, there's still a lot of, although the world is moving towards a greener economy, I think you would have to say the progress is slow, if slow at all.
It's slow, and it seems that it's not. It's a lot slower than it needs to be, from everything I've read. Something you mentioned in your blog article, which I thought was quite interesting, and you can just elaborate on this a little bit if you wouldn't mind. The speed at which previous energy transitions have happened. I mean, in the past, we've gone from coal to oil to natural gas. Now, obviously, all of these are fossil fuels, and they're all still very much a part of our power generation. But just talk us through the speed of each of the growth in each of those fossil fuels, and then I guess we can talk about the speed with which we need to try and kind of undo it all in terms of trying to create green energy.
Yes. So if you look previously, I think what's challenging about this shift in our economy is that we're trying to do it over a very short space of time. So if you look at previous energy transitions, let's say coal, for example, in the first 60 years, where coal went from not being an energy source to being just under 50% of the world's energy, that took about 60 years for that transition to happen. For oil and natural gas, it was actually slower. So for oil, over the first 60 years, it went from 0 to about 40% in those first 60 years. And then for natural gas, for its first 60 years, it only got to about 20% of the world's energy supply. So generally 6 decades, it takes decades for these kinds of transitions to happen usually, but we're trying to do this over a much shorter time period. So, we talked a little bit about the Paris Agreement. What's interesting about the Paris Agreement is they do cite it as being legally binding. So, it's seen as being more than just talk, but it'll be interesting to see how much teeth there actually is behind that agreement, because some commentators have said that although it's referred to as legally binding, in actuality, there's not enough or really any teeth if states decide to, for example, pull out or don't work towards meeting targets. But that Paris Agreement is trying to limit the increase in the global average temperature to 2 degrees. There's an aspirational goal of 1.5 degrees, but I'll say that's more aspirational, and that's over a much shorter time period than that 60-year period we've talked about. We're talking about 2035, 2030, 2025. So it's very different. We're looking to do this very quickly.
Yeah. All right, so let's try to get away from the science, I guess, and the backstory of all of this, and talk about it in the context of investment markets. Because as much as this is a problem, a big problem, and possibly an impossible task, there still are a lot of opportunities that get thrown up by this shift towards green energy. And I think I want to chat to you a little bit about that, because I think some of the opportunities are maybe not as obvious as what people might think. So I mean, let's start that conversation. Where are you seeing direct opportunities to benefit from or to invest in a greening of the global economy?
Yeah, in quite a few places, Garth. And I think you make a great point, because sometimes people, when we talk about opportunities that will arise from a green economy, people think of this as, number one, something that's far out, like, maybe 10 years down the line. And number two, they don't see it as a real potential source of investment returns, of sizable investment returns. So it almost becomes background noise sometimes to people. But what we've tried to convey is that we think that this is something happening, that has been happening, something that's happening now, and is only going to get big in the future. So the first point, given that I am a mining analyst, or that is one of my hats, the first point is definitely in the commodity space.
Yeah.
So there are certain metals or commodities that are very likely to enjoy much higher amounts of demand, given this transition that we're going to experience. One that gets thrown out all the time, and perhaps it's, people might get tired of hearing about it, but it gets thrown out because it's a legitimate potential place to look at. It's copper, or Dr. Copper. So copper's roughly about a 20 million ton market. That could be up to about 50 million tons by 2050, depending on how quickly we transition as a global economy. So you have a really unusual large increase in demand for copper, and supply could be slower to react. And I think you see that if you look at what some of the major mining companies have been doing. So Rio Tinto, for example, has recently been bidding on copper assets. BHP recently acquired copper assets. Anglo American has Quellaveco in South America, which is kind of its big growth project. So the miners are very aware that the supply demand outlook for copper could be very favorable, and it's a place that they're looking at. I think one cool stat on copper is that if you look at battery electric cars, they need 3 to 4 times as much copper as your traditional internal combustion engine. That gives a sense of some of the kind of increased demand that you could see. But in addition to copper, there's nickel, there's aluminium, there's cobalt, which is mostly coming out of the DRC. There's quite a
Yes.
few metals or metals and commodities that should benefit from this.
Lithium is another one, I think, as well. Yeah.
Yes, I
Yeah.
mean that's had an amazing run over
Yeah.
the past few years. Yeah, that's another
Yeah,
one.
yeah. And in terms of the companies that one could look at to invest in this, I mean, you've mentioned the likes of Rio Tinto, BHP Billiton, Glencore. These are company Anglo-American companies that we're all familiar with as South Africans, but there are others beyond the borders of South Africa as well.
Yes, so I think if you're looking at mining, I think we have decent options that we can access as South Africans on the JSE with some of the companies that you mentioned, the likes of Glencore, Anglos, there's also South32. But if we maybe step outside of mining for a second, some of the other places where we're seeing opportunity is kind of what we would term as being more downstream. So not companies that are mining the commodities that we're going to need for this transition, but companies that are kind of down the value chain.
Okay.
They tend to be a bit more consumer facing, although they can also be business facing. And in some ways, they are addressing climate change. So one of the things we looked at was the top 10 performers for the S&P 500 for the 5 years ending 31 December 2022. And three of the top 5 actually, with 3 of the top 10 also, are companies that are really central to this theme of climate change. So it was Enphase Energy, which has had an enormous run. Solar Edge and Tesla, which I think needs no introduction.
Yeah.
The first two, Enphase and Solar Edge, can, to put it simply, we can think of those as solar companies, and then Tesla, as we know, is a battery electric vehicle company.
Vehicle manufacturer. Yeah. I mean, that's the interesting thing, I guess, about looking offshore. Unfortunately, the JSE is very limited in terms of the opportunities to go for this type of theme. You've mentioned some of them there. I mean, when I think of companies in the space that, copper, I think of Freeport-McMoRan as a big copper producer listed in New York. And then there's, in lithium, there's, I think it's Antero Resources, if I'm not wrong, is one of those, is another one that is big in that sort of space. And then you mentioned the downstream ones, so like Enphase Energy, Solar Edge, Tesla. There are also ETFs that have been developed to take advantage of this entire theme. So, I mean, the ones I follow, ICLN, ICLN. It's I forget which it is now, but it's a clean, I think it's an iShares Clean Energy ETF. TAN, which is one of the great share codes, TAN, is also a green energy ETF. There's quite a few of these, right? It's a big theme.
It is, yeah, and I think it's for better or worse, it's only going to get bigger as time goes on. Yes, I think
go on.
Sorry, Garth, I think one of the tricky parts of this is defining what So ESG is a much broader term, but defining what an ESG fund is or what fits into a climate change portfolio ETF, I think that's not necessarily a challenge, but just something to, it's such a broad term that I think sometimes you do have to kind of look under the hood and see what's actually in either an ETF or a fund.
No, most definitely. I mean, some of those ETFs that I've spoken about did do very well for a period, and then they've done very, very badly during 2022. And I guess it also goes along with the fact that those companies that are in this space are also deemed to be growth companies in a way. So they are therefore affected by the interest rate. They're affected by discount rates. And when you see rates going up like they have done over the last year, then obviously the discounted cash flows, you bring it back into a net present value, it needs to be lower. So hence you've seen quite a significant drop off in value of a lot of these types of companies. But maybe that's the reset that was necessary to get the valuations back down to more reasonable levels and to then set the stage for investing in these things for the future.
Yeah, well, I mean, with those three US names that I mentioned, Enphase, SolarEdge, and Tesla. Also, I guess Tesla has gone on another run again. I think it's close to $200. But
Mm.
earlier this year, they had such a strong correction. But even after that correction, they were still sitting at kind of 50 plus PE multiples, and perhaps PE is probably not may not be the right metric to look at for some of these high growth companies. But it just gives a sense that definitely valuations were and are kind of spicy or very high in
Yeah.
some of these spaces, and you need to be aware of that.
I guess you've got to believe that they're going to grow into those valuations over time. And some will and some won't, I suppose. It's like any new theme. There are going to be those that make it and those that don't, and booms and busts. And we've sort of seen a bit of a boom and now a bust in some of this stuff. But I suppose the real winners in this area of investing will be the ones that we can start to see, which are surviving and leading the way out of this corrective phase that we've been in.
I think so. Yeah. I mean, we've seen, if we look at unprofitable tech on a more broader scale than 2021 and last year as well, a lot of stocks in that space were down 60, 70, 80 plus percent. But I think it gives the opportunity for us to search in the rubble and as you said, find the one or two that do seem to have legitimate stories behind them.
I guess the starting point I would possibly look at is go and actually take apart those ETFs that I've mentioned and have a look what the constituents are. And then me being a technical guy, you being more of a fundamental guy, I guess. But try and strip out which ones are looking like they've actually got are starting to lead on a relative basis, and maybe build a portfolio of those. Something else quickly to talk about is uranium. I mean, isn't this the one answer to a lot of these climate questions is nuclear power? If we're trying to do away with coal-fired power stations, etc., that emit all of these horrible things into the atmosphere, surely nuclear power has got to come to the table. I mean, I know it's a controversial topic, but in all of the research that you do you get the sense that this is something that ultimately we end up there in terms of power generation in an attempt to save the planet from the burning fossil fuels constantly?
Yes. So, I mean, as you referenced, if you compare nuclear power to, for example, coal, on an energy adjusted basis, the amount of deaths we get from coal is like significantly higher than we get from nuclear power. I think the challenge is the deaths we get from coal are unfortunately not always kind of front and center in our face. Whereas when you have an unfortunate nuclear disaster, that's very much in our faces, in the headlines, on front pages. And so it's from a political and social point of view, I think it becomes tricky given the history of nuclear with some of the disasters we've had. I think it has been challenging for some countries after what they've gone through with nuclear to try go down that road. But certainly, I think at some point, just if you look at the case for nuclear, I think it does have to become a bigger source of from a global perspective, of our power mix. Yes.
Are there any specific investments that you would look at in that uranium space if you believe that this could become a theme at some point? Is there anything that springs to mind?
I've read more about potential investments in the private, in the unlisted space. So I'm not as familiar with the listed space, but I do know there's a lot of work with a lot of smart people looking at nuclear fusion and nuclear fission. But in the mature listed space, I'm not as I don't follow as many names in that part of the market.
Yeah, likewise. I don't either. I need to do some homework there. The two that I do follow, there are two ETFs, which is URA and URNM, both uranium ETFs, uranium mining ETFs. And those are maybe something to watch. And again, perhaps drill into what the constituents of those ETFs are and then do some research from there. Let's just pivot away from this quickly, though. I mean, we've talked about some of the more obvious benefits, ways to benefit from investing in the green economy and going forward. But there's also something interesting happening here, which from purely an investment standpoint now, if we're looking at opportunities, is actually the fossil fuel industry is booming right now. And I guess that's also come about because of the fact that you've got there has been limited investment in new fossil fuel projects to drill more oil, to get more coal out of the ground. I mean, trying to get funding to start a coal mine nowadays just seems like it's impossible. But as a consequence of this, we still use a lot of fossil fuels. We will continue to use a lot of fossil fuels for quite some time to come. And yet we're not producing enough of this stuff. There's potentially supply and demand imbalances coming here, right?
Yes, Garth. I mean, everything's always 2020 with hindsight, but looking back at kind of the depths of COVID in 2020, when oil was getting destroyed.
Went negative for a period, the futures market. Can you believe it? Yeah.
I know, exactly. And I mean, with hindsight, I guess the market was at that stage was basically pricing in that we weren't really going to be using oil again, or to a significant degree as a global economy, which kind of seems funny now when you think about it. But you're absolutely right. I mean, for all the talk of renewable energy and this transition, if you look at where we are now, coal is still on a global basis over 30% of the world's energy mix, and coal is growing in Asia. It's despite the challenges that come with it, it's still going to be a big part of our power mix for some time. And I think a great example of this, probably for local investors will be familiar with this, was Thungela last year. Probably the most familiar export coal name on the JSE. So thermal coal prices were climbing before the Russian invasion of Ukraine, but I think that spurred the supply tightness because of the sanctions that were put on afterwards. And you had a situation where you had a commodity that generally was around, let's call it $90, $100 a ton. And I think the high it reached in 2022 was around $350, $360 a ton. I'm talking API4 or the Richards Bay benchmark coal price. So that coal price was up, let's say, 3.5 times at its peak. And it was really a case where you had a year of absolutely super abnormal profits for the coal sector. And as you said, part of it is just because supply is not growing to the degree that demand is. So supply is restricted. Thungela actually has, in some of their earnings calls, have made some interesting points. So, for example, they're looking at self-insuring now because they think it's the most economic thing to do. They want to keep at least 6 billion rand of net cash on their balance sheet during periods of high coal prices, and they've said that it's becoming increasingly difficult as a coal player to source funding at decent costs of capital. If you look at energy, maybe we're not as exposed as JSE investors, but if you look offshore, last year on the S&P 500, it was really the energy sector that was the only sector that was up. I think it was up 55%, whereas everything else was down. And a lot of these energy oil and gas CEOs are or have been banging the table saying that supply is just not growing at the pace that it needs to. So as you said, it's setting up a very interesting situation where funders or capital markets are increasingly moving away from fossil fuels. And as a result, we could have more price spikes in the future where demand for various reasons, there might not be a war, but various reasons in the future could spike, and we just won't have the supply to be able to deal with those increases.
Yeah. Something interesting that I noticed in that energy space that you referenced in the US last year, you said it was the top performing sector in the US by a long way. I mean, as you say, up over 50% for the year, in a year where the S&P 500 was down 20 odd percent. I kind of got the sense that energy, these oil producers and these big old-fashioned kind of energy producing companies had, to some extent, they'd become quite discounted in terms of their valuations on the basis or on the expectation that this is an area of the market that's not going to have a long-term future. And if you believe that a particular industry is not going to have a long-term future, well, then it becomes cheaper and cheaper and cheaper. And I think that's what happened in the energy space. And what's been interesting to note over the last, let's say, 6 months is that you've had quite a meaningful pullback in the oil price. Oil's off by about a third from its peak in the middle of last year. And yet, if you look at the share prices of a lot of these energy companies in the States, oil producers and the likes, and think of ExxonMobil and Chevron and these types of businesses, I mean, their share prices have not come down anywhere near the losses that you've seen in the oil price. They've remained at pretty elevated levels. And I'm just wondering, is that got to do with the fact that maybe the market is adopting a view that maybe this, terminal rate or terminal time of fossil fuels is not as soon as what was previously being priced in? Perhaps they need to add a couple of extra decades onto the life of these businesses, and therefore they can actually attract a higher valuation. That's, to me, what sort of would make sense for the big disconnect that we've seen between the movements in the oil price and the share prices of these big commodity producers and these big oil producers. So I don't know if you think that's a valid argument.
Yeah, Garth, I think that's actually a very interesting argument, and it's something that this disconnect you're talking about is something that in the office we've actually been, especially near the end of last year, we were debating it quite a bit, because, as you said, the equities or the share prices were holding up really well, and you had oil coming off, and it actually made us a bit nervous, in not nervous, but let's say cautious on some energy names. And really, I think the conclusion we came to is that something had to give. So they were likely to probably meet each other maybe halfway. So we were, let's say, concerned that the shares were probably going to come off a bit. Maybe oil would rally in the short term. But yeah, we were concerned that there was a disconnect. But I think you are, if you look at, let's say, the ultimate example of a long-term investor, Warren Buffett and Berkshire Hathaway, they've been buying Occidental Petroleum for a couple of years now.
Yes.
And I think that was the best performing. I'll have to double check that, but I think it was the best performing stock in the S&P 500. And I've watched a couple of interviews where he gave his thoughts on Occidental, and he's generally not the kind of guy to go in for like 1 quarter or 6 months or something like that. So he was basically saying, which is kind of similar to, in a different way, worded in a different way, but similar to what you were saying. He was saying that it's basically a bet for him and them on the long-term prospects on oil. And although it's having a good period now, he's really thinking about this in terms of years rather than quarters.
Yeah. Well, that's it. I mean, he goes into businesses with the intention to hold them forever in many cases. And I think it's one of his terms, this term cigar butt investing, which I've always stuck in my head. It's where you find the cigar that's been chucked on the floor by someone who was smoking it before, but it's actually still got a few puffs left in it. And if you find that, you can light it up and get, have some enjoyment out of it. And he looks at that from an investment standpoint and says, there are these industries that are maybe written off as being no use for the future, or they've got no life, no significant life. But actually, there is a lot of life left in them if you're willing to pay the cheap multiple and get the cash flows out of them. And I'm getting the sense that oil is one of those industries where, and I think the market has started to come to terms with the fact that it's not terminal. It's not going to be terminal for a long time. There is a lot of money left still to be made out of this, and hence we're starting to see a re-rating of the valuations of these kind of businesses, notwithstanding the weakness in the oil price.
Yeah, I think if you look at, maybe another good example is, I think last year we hit about 10% battery electric car penetration in terms of global car sales. Which is, it's ramping up very quickly, but that still means you have 90%, which was traditional internal combustion engines. And then on top of that, you have the current fleet, which for the most part is still traditional combustion engines. So if you just think of that part of this equation, it's going to take quite a while for us, even if we get to, let's say, 30% penetration by 2030, it's going to take a very long time for the existing fleet to transition to being predominantly, let's say, battery electric or a mix of battery electric and hybrid.
Yeah, no, absolutely. But it's interesting what you say there about the adoption of electric vehicles, because I don't think you guys see it as much in South Africa because obviously it's a different, the infrastructure is not really there. But here in the UK, it's actually amazing to see how many new electric vehicles are available. There's plenty of Teslas around here, but there's lots and lots of new ones coming out as well. Lovely cars, very interesting to see. And also interesting to see how the government is incentivizing people to buy these cars with tax breaks, et cetera, et cetera. So it's, and I guess that's where you kind of got the legislation being put in place in the developed world to try and speed up this green energy revolution. So Leo, we're running out of time. The last question I wanted to ask you, and you perhaps have already touched on it a little bit, but how are you positioning client portfolios for this green energy revolution now? If you've got a green energy mindset, or you've got a, investing with your green hat on, let's put it that way, where are we looking? How are you positioning portfolios?
Yeah, Garth. So I think this is always where the rubber meets the road, and it's nice to talk about a theme, but then actually putting it into action is a bit different. Certainly on the JSE, the miners. So we have been looking quite closely at the diversified miners. We have historically owned Glencore. At the moment, so we do like the longer term story in terms of its commodity mix. It has copper, cobalt, nickel, zinc, a lot of these commodities that we talked about earlier. However, last year, in the first 6 months of 2022, roughly 50% of its profits came from thermal coal, for the most part, which is ironic because it's touting itself as it's kind of a future green play. And so the only concern there is that Newcastle coal, if you look at the Newcastle benchmark coal price, that's gone from about $400 a ton at the start of January to roughly $250 a ton today. So it's off by quite a bit, close to 40%. And it's just given that coal was such a big part of their profits in the first half. I think you might have a bumpy period where the profit mix needs to kind of readjust. But over a bit of a longer term, we think that's quite an interesting way of playing this theme. South 32 is another one. About roughly 50% of their business is what you can call the aluminium value chain. So that's aluminium, that's bauxite, alumina, aluminium. They've bought a copper asset recently. It's still small in their mix, but it should grow over time, and I think they'll be looking within that space still. And then offshore, at the moment we are really just doing a lot of work or homework on the space. So we are trying to be valuation cognizant. So as you said, especially given the fact that we're in a rising rate environment, although that has paused for now, but we are cognizant of maybe not paying some of these let's call them steamy multiples. But at the moment, we're really just doing a lot of work, and we want to be ready for if there are further corrections in terms of share prices for, let's say, some of the solar companies. The battery electric car space is very interesting. I think offshore, there's probably a bit more ways to play this.
Yeah, there are certainly a lot of ways to play the theme offshore. Yeah. Excellent. Well, Seleho, it's been a great pleasure speaking to you. I've looked forward to this conversation, and it's been insightful. Thank you very much. I'm glad to have got you on. You're the first member of the Anchor Capital team that I've got on the podcast, and I certainly hope some of your colleagues will come along and give us some of their insights in the future as well.
No, thanks for having me, Garth. I'm surprised the time's gone so quickly. It feels like it's been 10, 15 minutes.
Well, they say time
Pleasure.
flies when you're having fun. Thanks for joining me.
Pleasure. Thanks, Garth.
Cheers. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.